An initial public offering or IPO is a formal process of converting a private company into a public one. But why would a company do this? Why open ownership to thousands of strangers? Well, let's find out. Hello and welcome to Alice Blue, where we simplify everything you need to know about trading, investing and personal finance one step at a time. A company in its early stages, often called the seed stage, usually receives funding from friends, family, and high net worth individuals, or angel investors. As the company shows growth potential, venture capitalists comes in with Series A, B, and C rounds, offering even larger sums to help expand the business. Now, by the end of these funding rounds, the company may have expanded from hiring a few people to opening international offices. But as it grows, it needs more capital beyond what venture capitalists or angel investors can provide. Now, this is where an IPO comes into play. It allows the company to go public, reaching out to tens of thousands of retail investors to raise the needed funds. Keep in mind that it is illegal for a private company to raise funds from the public before this process. Now, although it's called an initial public offering, not all the shares go to the general public. 50% of the shares are reserved for qualified institutional buyers or QIBs, like mutual funds, insurance companies, pension funds, etc. So if a company offers ₹1,000 worth of shares, QIBs get ₹500. 15% go to the non-institutional and high net worth investors or the HNIs, basically wealthy people who can place large orders. So they get about ₹150 worth of shares. Now this leaves the 35% for retail investors. So around ₹350, which is shared among millions of such investors. But you can't just go and buy these shares instantly. First comes a subscription process where investors show their interest in buying shares at the offered price. Depending on the demand, shares are then allocated in each category: QIBs, HNIs, and retail investors. Sometimes the IPO is oversubscribed, meaning demand exceeds supply, and not everyone gets the shares they applied for. Once the shares are available, investors usually fall into two categories: flippers and long-term investors. Flippers are investors looking for short-term gains. For example, in this case of Sri Ahimsa Naturals, the closing price was ₹147 and the issue price was ₹119. Now, a flipper could just flip the stock and sell it immediately, earning a profit of almost 18%. Long-term investors, on the other hand, are focused on the stock's growth over months or even years. For instance, with Arunaya Organics, the stock initially saw a 48% loss, but over time it recovered and reached a 22% gain, allowing long-term investors to profit from the company's eventual turnaround. Choosing between being a long-term investor or a flipper depends on your goals and risk appetite. For example, here, flippers lost 8% while long-term holders gained 19%. On the other hand, with this company, flippers gained 4% while holders lost 6%. So an IPO isn't just a money-raising event for a company. It's a big leap into the public spotlight. And as an investor, understanding how IPOs work helps you make smarter and more informed decisions. If you found this video helpful, make sure to like and subscribe to our YouTube channel for more such informative content. If you want to learn how to apply for a company's IPO, make sure to check out this video.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.